When people imagine venture capital, they often imagine billion-dollar funds, famous investors, and enormous checks being written to the next generation of technology giants. But some of the most interesting investors in the startup ecosystem operate on an entirely different scale. Their funds may be smaller. Their teams may consist of only a handful of people. Their investments may sometimes be measured in hundreds of thousands rather than tens of millions, and yet they can become some of the earliest institutional believers in companies that larger investors haven't even noticed. They are often called Micro VCs. Imagine two founders raising their first serious round of outside capital. One approaches a massive venture fund managing billions. The other approaches a specialized $30 million fund investing exclusively in companies like theirs. Which investor is actually more important? The answer isn't as obvious as it might seem, because venture capital isn't simply about who has the most money. It's about who understands the opportunity, who is willing to invest early, who can make decisions quickly, and who can help a founder reach the next stage. So what exactly is a micro VC? Why have smaller specialized funds become an important part of startup financing? How do they make money? Why might founders deliberately choose them over larger investors? And what happens when thousands of smaller funds begin competing for the world's most promising startups? This is Get to Know Micro VCs, the rise of small specialized funds. Today on MP Nerds, we're going inside one of the most interesting corners of modern venture capital. To understand micro VCs, we first need to understand a problem created by venture capital itself. Traditional venture funds became extraordinarily powerful financial institutions. As successful firms raised increasingly large pools of capital, something interesting happened. Their economics began changing. Imagine a venture fund managing $2 billion. Investing $100,000 into an early startup might produce an incredible return if that company becomes successful. But even a spectacular return on such a tiny investment may barely affect the overall performance of a multi-billion-dollar portfolio. Large funds therefore often need sufficiently large investment opportunities to make their economics work. That creates a potential financing gap. Between individual angel investors and major institutional venture funds sits an enormous population of startups. They may have a prototype, a few customers, early revenue, an impressive founding team, or simply an unusually promising idea. But they may not yet need or qualify for a massive institutional financing round. Smaller venture funds emerged as one way of addressing this part of the market. Over time, the term micro VC became commonly associated with relatively small venture capital funds that frequently invest at the earliest stages of a company's development. There is no single universal dollar threshold that magically turns a fund into a micro VC. Definitions vary. A fund considered micro in one market or era may look very different in another. The important idea is relative scale. These funds are generally smaller than major traditional venture funds and frequently concentrate their capital on pre-seed, seed, or other early-stage opportunities. But something else happened. Smaller funds discovered they didn't necessarily need to compete with enormous VC firms on size. They could compete on something else: specialization. A fund could focus entirely on cybersecurity, artificial intelligence, climate technology, healthcare, fintech, developer tools, robotics, consumer startups, a particular geography, or founders with specific backgrounds or experiences. And that changed the competitive equation. Instead of asking, how can we become another giant VC firm? The question became, what can we understand better than almost everyone else? Micro VCs don't exist in isolation. They occupy one part of a much larger startup financing ecosystem. Reality is much messier than this diagram. These categories overlap constantly. A micro VC might invest alongside angels. A large venture firm might invest at seed. An accelerator may operate its own investment fund. A corporate investor may enter extremely early. And a startup might skip several stages entirely. But micro VCs can occupy an especially interesting position. They can provide institutional capital at a very early point in the company's development. That matters because the earliest stages of building a company are often characterized by uncertainty. Will customers buy the product? Can the founders build it? Is the market large enough? Can the company recruit talent? Will its technology actually work? Can it raise another financing round? These questions create risk, but they also create opportunity. A company valued at billions later in its life may once have been a tiny startup desperately trying to raise its first institutional check. Finding exceptional companies before everyone else notices them is therefore one of the central challenges of early-stage investing, and specialization can become an advantage. Imagine a startup building software for an extremely technical industry. A generalist investor may need weeks to understand the market. A specialized micro VC might immediately understand the customers, the competitors, the regulatory environment, the technical challenge, the pricing model, and perhaps even the people the startup should hire. This is where small funds can become strategically significant. They aren't necessarily trying to dominate the entire venture capital industry. They may be trying to dominate a specific corner of it. At its core, a micro VC is generally a relatively small venture capital fund that invests professionally into startups, frequently at early stages. But understanding the structure requires knowing the participants. The limited partners. The investors providing capital to a venture fund are generally known as limited partners, or LPs. Depending on the fund, LPs might include wealthy individuals, family offices, institutional investors, corporations, funds of funds, or other qualified investors. Imagine a micro VC raising a $25 million fund. The managers aren't necessarily personally contributing all $25 million. Instead, they raise commitments from investors. The general partner. The fund is typically managed by the general partner, or GP. The GP and investment team identify startups, conduct due diligence, make investment decisions, and manage the portfolio. The investment thesis. Then comes one of the most important concepts, the investment thesis. A strong micro VC usually isn't simply saying we invest in startups. It may say we invest in European B2B cybersecurity companies at pre-seed and seed, or we back AI infrastructure companies founded by deeply technical teams, or we invest in climate technologies capable of transforming industrial processes. That thesis helps determine which opportunities deserve attention. The fund economics. Venture funds typically have a defined amount of committed capital. That capital must be allocated strategically. Suppose our fictional micro VC manages $30 million. It might decide to make approximately 30 initial investments averaging $500,000. That would use $15 million. Does it immediately invest the remaining $15 million into another 30 startups? Not necessarily. A substantial portion might be reserved for follow-on investments. Why? Because some portfolio companies will progress. They may raise additional rounds, and the fund may want to continue investing in its strongest companies. This creates one of the hardest decisions in venture capital. How much capital should you invest now, and how much should you save for later? Ownership. Suppose a startup raises $1 million at a $4 million pre-money valuation. After the investment, its theoretical post-money valuation becomes $5 million. If one investor supplied the entire $1 million under that simplified scenario, the investor would own approximately 20% immediately after the financing, before considering other complexities. But micro VCs frequently invest alongside other investors. Their ownership may therefore be much smaller. Portfolio economics. Here's where venture capital becomes fascinating. Startup outcomes aren't normally distributed evenly. Some investments may fail completely. Others may return modest amounts. A small number may generate enormous gains. This produces what is often described as power law behavior. One extraordinary company can sometimes produce a disproportionate share of a fund's overall returns. That's why micro VCs aren't merely asking, could this company succeed? They're often asking something much bigger. If this company succeeds spectacularly, could our ownership actually matter to the fund? The 5-stage micro VC process. A simplified investment process might look like this. 1. Sourcing. Finding promising founders. 2. Screening. Determining whether opportunities fit the fund's thesis. 3. Due diligence. Evaluating the founders, market, technology, traction, competition, economics, and risks. 4. Investment. Negotiating terms and providing capital. 5. Portfolio support, helping companies with introductions, hiring, strategy, fundraising, and other needs. And eventually, the fund hopes some investments generate liquidity through events such as acquisitions, secondary transactions, or public market outcomes. But that may take many years. Venture capital is patient capital, and patience is one of the industry's biggest hidden requirements. So what does this look like from a founder's perspective? Imagine a fictional startup called Quantum Shield. 3 engineers have developed a promising cybersecurity platform. They have a working prototype, 6 pilot customers, $120,000 in early annualized recurring revenue, and approximately 8 months of cash remaining. They want to raise $1.5 million. They approach several investors. One is a huge generalist venture fund, another is a $40 million micro VC specializing entirely in cybersecurity. The large fund likes the company, but there's a problem. Quantum Shield is simply too early. The investor says, "Come back when you're at $2 million in annual recurring revenue." The micro VC sees something different. Its partners understand cybersecurity. They know the customers. They recognize the technical problem. They've invested in adjacent technologies, and they've seen similar companies develop. So they invest $500,000. They introduce another seed investor. The round closes, but capital isn't the only contribution. 3 months later, the micro VC introduces Quantum Shield to a potential enterprise customer. 6 months later, it recommends a senior sales executive. 10 months later, it introduces the founders to several larger Series A investors. This illustrates an important principle. The value of an investor isn't necessarily proportional to the size of their check. For founders evaluating micro VCs, several questions become important. Does this investor understand our market? Do they have a good reputation with founders? Can they support future fundraising? How quickly can they make decisions? How much ownership do they expect? Do they reserve capital for follow-on rounds? Will they help when things go wrong, not just when everything is going well? And perhaps one of the most overlooked questions, what do their existing founders say about them? Founders conduct due diligence on investors too, because taking investment isn't simply receiving money. You are potentially beginning a relationship lasting many years. Micro VCs are surrounded by several misconceptions. Myth number 1, smaller fund means inexperienced investor. Not necessarily. Some micro VCs are managed by former founders, operators, engineers, or investors with extensive industry experience. Fund size and expertise are completely different variables. Myth number 2, the investor writing the biggest check is automatically the best investor. Again, not necessarily. Capital matters, but so can expertise, responsiveness, introductions, reputation, network, and alignment. Micro VCs only invest because larger investors rejected the company. This misunderstands specialization. A company may intentionally target specialist funds because those investors understand its market better. Myth number 4, more portfolio companies always means better diversification. Not automatically. Portfolio construction involves trade-offs involving ownership, reserves, concentration, and risk. Too much diversification can result in investments too small to materially affect fund performance. Too much concentration can create enormous exposure to individual failures. There is no universally correct portfolio strategy. Myth number 5. If a micro VC gets into a future unicorn early, the fund automatically makes enormous returns. Not necessarily. Entry valuation matters. Ownership matters. Dilution matters. Follow-on decisions matter. Exit value matters. Fund size matters. And the amount ultimately returned to the fund matters. A famous company doesn't automatically equal an extraordinary fund investment. Fact or fiction? Because micro VCs manage smaller funds, they always take less ownership in startups than large VC firms. Fact or fiction? 2-1. Fiction. Fund size alone doesn't determine ownership requirements. Ownership targets depend on strategy, valuation, investment size, competition, financing structure, and the fund's economics. And this leads to a larger debate. Should micro VCs remain small? Some investors believe staying small preserves focus, flexibility, and exceptional fund economics, Others successfully raise larger successor funds as their strategy proves itself. But growth creates a paradox. The more capital a micro VC raises, the harder it may become to continue behaving like a micro VC. At some point, the fund itself begins changing. Micro VCs are often confused with angel investors, accelerators, and traditional venture funds. Let's separate them. Angel investor usually invests personal capital, can be extremely flexible, often invests very early. Decision-making may involve one individual. Micro VC invests through a professionally managed fund, usually has an investment thesis, often focuses on pre-seed or seed opportunities, may provide institutional credibility and structured portfolio support. Accelerator usually operates a program rather than functioning purely as an investment fund, may provide mentorship, education, networks, and sometimes capital in exchange for equity or under another investment structure. Traditional VC typically manages larger pools of institutional capital, may write larger checks, may participate across multiple financing stages, often has larger investment teams and broader portfolio support infrastructure. But these distinctions are not absolute. The venture ecosystem constantly overlaps. A micro VC can run an accelerator. An angel investor can create a fund. A giant venture firm can launch a seed strategy. And a successful micro VC can eventually become a much larger venture firm. So founders shouldn't become obsessed with labels. Instead, ask, what does this investor actually offer? Capital, expertise, network, speed, reputation, follow-on capacity, strategic alignment. Because the name on the investor's website matters far less than what happens after the money reaches your bank account. Micro venture capital has already changed significantly, but technology could transform it even further. Artificial intelligence may increasingly help investors analyze enormous quantities of information. Startup databases, market intelligence, hiring patterns, customer signals, technology trends, competitive landscapes, founder networks, financial performance, AI-assisted systems could make sourcing and preliminary analysis dramatically more efficient. But there's an interesting paradox. If every investor eventually has access to powerful AI analysis, information itself may become less of an advantage. Human judgment could become even more important. Can you recognize an extraordinary founder before the numbers prove they're extraordinary? Can you understand a market everyone else thinks is too small? Can you see why an unusual technology might matter 5 years from now? Those questions aren't easily reduced to a spreadsheet. We may also see increasing specialization. Instead of another generic technology fund, future micro VCs may focus on incredibly narrow areas. Quantum computing, space infrastructure, synthetic biology, industrial robotics, AI safety, defense technology, longevity, vertical software, climate adaptation, or technologies that barely exist today. Geography may change too. Startup ecosystems are increasingly distributed. The next breakthrough company doesn't necessarily need to begin in Silicon Valley. Specialized investors can potentially discover founders across Europe, Asia, Africa, Latin America, the Middle East, and emerging startup ecosystems around the world. But risks remain. More funds mean more competition. More capital can contribute to inflated valuations. Specialization can become dangerous if a fund misunderstands its market. And inexperienced managers may discover that selecting investments is only one part of operating a successful venture fund. Fundraising, portfolio construction, governance, reporting, compliance, LP relations, reserves, follow-on strategy, and exits all matter. The future of micro VC therefore isn't simply about creating more small funds. It's about creating better specialized investors. Investors capable of discovering exceptional founders earlier and helping them become exceptional companies. Today, we discovered that micro VCs represent an important part of the startup financing ecosystem. They generally operate smaller venture funds and frequently invest during the earliest stages of company development. But their real advantage isn't necessarily their size. It can be their focus, their specialization, their speed, their networks, their willingness to understand opportunities before those opportunities become obvious. We also learned that smaller doesn't automatically mean less sophisticated. A specialized micro VC may understand a particular market more deeply than an investor managing billions. And for founders, choosing an investor shouldn't simply be about finding the largest possible check. It should involve finding the right combination of capital, expertise, network, reputation, and long-term alignment. Perhaps the biggest lesson is this: venture capital isn't only about predicting which companies will become enormous. It's about recognizing extraordinary potential while that potential is still uncertain. And micro VCs are increasingly competing to do exactly that. But understanding micro VCs raises another fascinating question. Where does their money actually come from? Who invests in the investors? And why would someone commit millions of dollars to a venture fund knowing it could take a decade or more to discover the final result? In another episode of Get to Know, we'll explore limited partners, the investors behind venture capital. If you found this episode valuable, hit the like button, subscribe to MP Nerds, and tell us in the comments. If you were launching a micro VC tomorrow, what industry would you specialize in? Artificial intelligence? Cybersecurity? Climate technology? Robotics? Healthcare? Something completely different? We'd love to hear your investment thesis. And if you're building a company yourself, remember that becoming investable involves far more than creating a pitch deck. Investors may examine your market, traction, strategy, financial model, team, risks, documentation, and ability to execute. Continue exploring business, technology, investment, entrepreneurship, and the tools shaping tomorrow at mpnerds.com. Keep learning, keep building, keep questioning how the world's most interesting businesses actually work. Thank you for watching MP Nerds, part of the MP Nerds ecosystem.